Hi everyone, good evening. Thanks for joining us today. We'll give a few minutes for everyone to join. So we'll start it at around 8:32 Central. Can everyone hear me? You can maybe put your comments in questions or chat. Thanks, Prab. We'll just start in a couple of minutes. Taisha, I think we can get started.
Thank you, Surbi. Welcome, everyone. I bet you can recognize my unique audio identity. Thank you for taking the time to evaluate this opportunity. If you're on the East Coast and this is past 9 p.m., I'm grateful for you being here this late. We will spend the first half of the call going over our business plan, and we will have time at the end to address any questions. We will start with the general and financial disclaimer. This is a 506B offering, which means that this information is only for people that have a pre-existing relationship with one of the sponsors. This business plan contains privileged and confidential information and is for informational purposes only. We cannot generally solicit investors. Potential investors are also cautioned that these forward-looking statements are predictions only based on current information. Assumptions and expectations are subject to risks and uncertainties. There are several future financial projections and forecasts, and these are the estimates which are based on assumptions which may or may not hold true. It's my pleasure to kick off this evening with an introduction with our sponsorship team. First, let's take a look at their track record. Together, they have over $250 million in assets invested, over 3,000 doors, and so far, they have raised over $50 million from other investors. As you will see, this is a diverse group of people with extensive real estate experience. In addition to multifamily, they have experience with single-family, commercial real estate, construction, and project management, as well as mortgage brokerage experience. Starting with Surbi and Akhilesh, they are general partners and passive multifamily investors with full cycle experience. They have deep experience with distressed assets, foreclosures, and rehab projects, and they both hold engineering and MBA degrees. Together, they made this project possible. Hanumesh is also an engineer with experience in multifamily acquisition. He has been successful in single-family home flips. Steve adds the construction and project management experience to the table and holds a degree in business management. Steve's superpower is underwriting and business planning. Jai has a large single-family portfolio and is rapidly growing his multifamily doors. He's also an engineer and oil technologist with a success history of driving technology innovation. Last but not least, we have Mo Pacnia. Mo is a real estate broker, a certified REO specialist, and a previous mortgage broker. He's been helping investors build their real estate portfolio beyond the single family or multifamily space. On my end, I'm working on building my portfolio, which currently stands at over 3,000 doors, so I can eventually get out of the rat race. I'm a director of financial for a consumer packaged goods multinational, and I have an accounting and MBA degree. Here are our partners in this deal. Patel Law Group is our securities attorney. Mayan Management is our property management. BMC Capital assisted us with the financing, and Remy King will be our insurance provider. Next, I'll pass it to Steve, who will walk us through our property details. Steve, go ahead, take it away.
Thank you, Tasia. Good evening, everybody, and thank you for joining us. Next slide, please. So a couple highlights here I'm going to dive into. This is a 95-unit multifamily portfolio. One of the things that we really like about this property being purchased together as a portfolio is that all 4 assets are unique. We'll get into those in the next few slides here, but I'll explain all that to you. This is a highly coveted location in East Dallas, submarket of Dallas. It's just blocks away from downtown, uptown, Deep Ellum, Knox Henderson. And this property was completely renovated in 2018 with high-class interior finishes, which you'll see in some of the pictures to come. Fitted out with stainless steel appliances, individual brand new HVACs, and a brand new PVC plumbing system all the way back to the street. Next slide. So a couple key metrics here, 95 units. These properties, so there's 4 total properties, one of which built in 59, 2 in 62, and 1 in 64. All 4 of them were completely gut renovated in 2018. The current occupancy is 94%, which in the multifamily world we consider stabilized, which is very good for us. The utilities currently, which this is important, and I'll get more into this in the financials, but currently it is all bills paid, meaning when new tenant moves in or comes in, their rent includes everything with the exception of electric. They'll set that up by themselves. The roofs are a mix between pitched and TPO. Total rentable square feet is 46,732. 4 buildings, and the exterior on all 4 of the properties is brick. Some of the amenities that we have, some of which are unique. All the tenants, it doesn't matter what building you live in, they're all right next to each other. They share a gated, it's a gated community, so everyone shares the same parking lot. So they have access to both of the courtyard pools, 2 of the fitness centers, laundry facilities, barbecue grill. One of the properties has a rooftop patio, which is gorgeous. It has a great view of downtown Dallas and a great sunset. And then a patio with a fire pit. Another included amenity is premium Wi-Fi package that also comes to the tenants for free. It's technically included in their rent. Next slide, please. The first property is Koa. Koa is a Hawaiian forest themed property. You'll see if you take a look at the shower, you have the pebble, the rock down at the bottom. You have some cedar and some unique features outside in the pool courtyard. And then some other interior finishes that give it more of a Hawaiian theme. As you can see in the kitchen, stainless steel appliances, gooseneck faucet in the kitchen, nice hard countertops, and great landscaping out front. Next slide, please. French Quarter is designed after the New Orleans French Quarter neighborhood. It's also very unique, has some unique fixtures inside, which we've talked about replacing with something a little more modern. Again, unique finishes. It gives tenants different look and feel, and they'll have options of all four. This also has a courtyard area as well. Sorry, you can go to the next. San Jose is the next property. San Jose has 23 units. This property was actually rebuilt, not just from the studs, but taken down to the foundation. This has been built with a Spanish twist, so you can tell by the unit front doors in the bottom right photo. More of a wood heavy door with a cool little peephole there. Great finishes, shaker style cabinets, great lighting, very modern, hardwood floors throughout. The bathrooms are very gorgeous. Mirrors have trim, and then some of the exterior is good. We can do some work there, and that's part of one of the things that we can work on. The other thing to note here is the washer dryer connections. There's not all of the units, not all 95, but most of the units do have washer dryer connections. And when Jai comes up to talk about the business plan, you'll hear more and what our plan is for the washers and dryers. Next slide. Vintage is a 24 unit property. This is a little more of a modern feel to it. This is also the property with the rooftop rooftop lounge, which you can see on the bottom left picture. Again, stainless steel appliances. It has a courtyard pool with a lounge area. This also has a cardio fitness facility, individual HVACs, and it also has washer and dryer connections. Next slide. Now for the market. Why we invest in Texas. We've been extremely impressed with the growth of Dallas-Fort Worth Metro, which has us confidently investing in our own money in this market. The two most important market data points we look at are population growth and job growth. Texas was the fastest growing state in the country in 2020. It's still the fastest growing metro in 2020 and 2021, according to the U.S. Census Bureau, adding over 97,000 residents over the past year. This is in part due to Texas's booming economy, coming in second only to California at $2 trillion. Texas offers a business-friendly climate with no corporate or personal income tax, easy access to global markets, and a highly skilled and diverse workforce. Next slide, please. Dallas is home to 24 Fortune 500 companies, including AT&T, Southwest Airlines, and Charles Schwab. The continued influx of large private and public companies relocating to Dallas has helped push job growth to over 248,000 new jobs year over year. Relocation reports over the past few years have shown staggering numbers for both domestic and international migration to the great state. Next slide. To summarize the past few slides, here's a roll-up of the top 4 reasons Texas is seeing such high demand and growth, and will continue to trend in this direction. Strong job market and wages. Booming job growth has turned Texas into an economic powerhouse. On the world stage, Texas would be the 10th largest economy among nations. Second is lower cost of living. Texas residents enjoy some of the best living conditions in the country. Energy costs are among the lowest in the country due to deregulation. The third is taxes. As stated previously, Texas is one of the 7 states in the country that don't collect personal income taxes, and it's family-friendly and diverse. Dallas is known for its art district and sprawling parks for outdoor activities, professional sports, amusement parks, nightlife, as well as shopping districts and boutique restaurants. Dallas is also home to some of the best school districts in the country and ranks 2nd in diversity. Next slide, please. Sales and cap rates. One of the many reasons we are extremely excited about this property is the purchase price. San Jacinto is being acquired at $137,000 per door. In relation to recent sales over the past year, East Dallas has an average price per door of nearly $200,000. in 2022 and forecasted to increase another 15% over the next 4 years per CoStar. There's another slide coming up that we'll talk more about and show some of the other recent sales in the East Dallas region. The graph to the right is cap rates. Cap rates, for those that may be unfamiliar, the cap rate or capitalization rate is the ratio between the annual net operating income produced by the asset to its current market value. Property values increase when income increases, expenses are reduced, and or the market cap rate compresses. As operators, we focus on the controllables and expect a higher cap rate at time of sale. As you can see on the chart on the right, cap rates have been falling the past 5 years from 5.4% to about 4.5% in 2022 in the East Dallas market. CoStar forecasts cap rates in 5 years to be in the 4.6 to 4.7 range in this submarket, which would yield even higher returns for investors. More on this in the financial section when I'll cover cap rate sensitivity. Next slide, please. Demographics. Often accompanied by a great location is a strong median household income at $65,397 in a 1 mile radius, which supports the market being able to absorb future rent hikes. Household growth in a 1 mile radius has impressive growth as well at 4.3% year over year. A couple other things to note here on the graph on the right is the median home value. Obviously, lately that's going up and then you tack on interest rate hikes at 6-7% for median home value. Home ownership is out of touch for a lot of new and young homeowners. Next slide, please. East Dallas rent and vacancy. With Dallas's great economic drivers comes strong demand in rentals. The East Dallas submarket effective rent is up 15.8% year to date, and occupancy is consistently hovering at the 93 to 96% mark. Rent growth is expected to slow down, however, still net nearly 5% rent growth on average over the next 5 years. And when I get to the financials, you'll see how we have this property underwritten. Next slide, please. The East Dallas submarket. East Dallas provides an extremely attractive up-and-coming alternative for renters priced out of the uptown and downtown submarkets just to our west, yet still in close proximity to vast cultural attractions and major employment centers. We are in the path of development and regentrification as developers have honed in on the vibrant East Dallas submarket and focused on attracting young renters to all the area has to offer. Next slide. As we can see on the map, renters enjoy close proximity to downtown Dallas, just 2 miles away, Deep Ellum, the live music capital of North Texas, as well as a hub for performing arts, Lower Greenville to the north, a quaint neighborhood just a few steps north of San Jacinto, offering a robust scene of bars and ever-increasing number of noteworthy restaurants. Next slide, please. I'll now turn it over to Jai to walk us through the business plan.
Thank you, Steve, and good evening, everyone. As mentioned earlier, this is a Class A portfolio, which was fully renovated in 2018, which means that we don't have to have a huge rehab budget to do a lot of things here. So in our business plan, we have considered some value-add projects which would drive our growth in the rental income, and we would have new streams of revenue from other income. So we have considered few interior upgrades, such as changing cabinet handles to brush nickels, changing some light fixtures and faucets in some of the select units, as Steve mentioned earlier, install the backsplash in kitchen area, and we have one 1,200 square foot of townhouse that currently has 1 bedroom and 1 bath. We plan to add a second bedroom to that so that we can increase the rental income from that. To add to the new stream of revenue from the other income, as Steve mentioned earlier, we have some select units which have the washer and dryer connections. So we would add washer dryers in those units. We would also build some covered parking slots. We would also install some smart tech packages such as Ring doorbells, smart thermostats such as Nest, and we will also implement valet trash, which is in high demand in Dallas market at the moment. So all these implementation would allow us to increase our other income on a monthly basis. In order to improve the tenant retention, we would do some modification and improvement in landscaping and change some of the pool furnitures. Finally, we are working with our property management company, where we are reviewing all the vendor contracts and looking for the opportunities to optimize our expenses and reduce the overall cost. Next slide, please. So this slide here shows the impact of new stream of other income revenue on the value of the property. And most of you may know that value of the property is calculated by net operating income divided by capitalization rate, as Steve mentioned earlier. So let's look at one of the revenue stream, let's say row 3 here, which is washer and dryer income, and see how it impacts the value of the property. So we plan to add washer and dryer in 40 units in total, and we would charge $50 per month for each of these washer dryers. This would increase our net operating income on annual basis by $24,000. Now, considering 5.25% cap rate, which we have considered in our underwriting, this $24,000 annual income will increase the property value by $457,000. So by doing all these improvements, as mentioned here, as a covered parking, valet trash, townhome conversion to 2-bedroom, we would be able to increase our value of the property by $1.12 million. Next slide, please. Now this slide here shows the CAPEX budget allocation. As mentioned earlier, we don't have a huge CAPEX budget because the property was renovated down to studs in 2018. So we have $400,000 of total CAPEX budget here, where we have allocated about $10,000 for the minor patchwork for the roof repair, and we have allocated about $25,000 for improving the drainage system from the rainwater. We have $40,000 we'll use to build those covered parking lots, and then we will have $100,000 put aside as a deferred maintenance, which we can use as needed. The table on the right side shows some of the interior upgrades which we want to do just to make sure that all the units looks pretty good. We have allocated about $15,000 for the town hall conversion to bedroom. So basically, important point I would like to mention here is that all this CAPEX budget, we have unfinanced budget here, which means that we will have the full control of using this budget as and when needed. Generally, when you finance the CAPEX budget, lenders have a control on how and when to use the budget. So in this particular case, since we are raising this CAPEX budget, we will have full flexibility of utilizing it as needed. Next slide, please. Well, I'll pass it on to Steve to take you through the financial highlights.
I'll take this first part, Jai.
Okay, thank you, Taisa.
So let's look at some financial highlights. The business plan was developed for a 5-year hold, and we are projecting a total return of 97%, which means investors will double their money in 5 years. The cash on cash, which will be the yearly distribution, is expected to be 5% on average. On the financing side, we secured a fixed rate interest rate loan at 5.13 from Freddie Mac. This is top of mind now that the interest rates are expecting to go up, and this will protect us, and it's a known variable right from the beginning through underwriting. The loan amount is $8.2 million at a 63% loan to value, which make the purchase price of this property at around $13 million. As Steve mentioned, this property is one of the best submarkets in the Dallas-Fort Worth Metroplex, which experienced the growth of 15.4%, which is one of the best in the area. We are also excited, and we are mentioning again the fact that we are buying this at $137 price per door, which compares favorably to the similar properties sold in the area, which we're going to show you in a little bit. Also, the employment opportunities are within miles of this location, as well as sought after medical facilities, entertainment, and retail venues. The local economy is diverse and based on banking, commerce, insurance, telecommunications, technology, energy, healthcare, medical research, transportation. Why I mentioned that is because Dallas is not depending on a single industry, so it's not a concern. We also, as Jay pointed out, have multiple opportunities to increase revenue in this property. This slide shows properties sold in this neighborhood between February and June 2022. So it's really recent. As you can see, the lowest price was $158,000 per door, and the highest price was at $190,000 per door, which explains why we are excited by the $137,000 we are paying on this property. This is the disclosure of fees. The acquisition and asset management fees will be at 2%. There will be no refinancing or disposition fees, and the sponsor split will be 80-20, with 80 going to the passive investors and 20 to the sponsors. That said, once we double the investors' money, they split for any incremental gains will be on a 70-30, which means the investors will get 70 and the remaining portion will go to the sponsorship team. Steve, take it from here and walk us through the underwriting, please.
Beautiful. Thank you, Tasia. So I'm going to start over on the left-hand side where you can see the sale price. We're acquiring this property for $13 million. Original ask for this was 13.8. So we got a great deal on this market, on this property, which came due to a great broker relationship with Serby and Akalesh. So as Tasia mentioned before, that relationship was great, and this deal came to us in great part due to Serby and Akalesh and their relationship with this particular broker. Number of units is 95. The cost per unit, as we stated a few times, is $137,000 per door, which is fantastic for this market. Our financing, which is another huge benefit to this property, is a 5-year Freddie Mac SBL loan. The loan amount is $8.19 million. Leverage is 63%, and we have 1 year of interest only. Now, this was a business decision. Obviously, the debt market is very diverse right now. We chose fixed rate for obvious reasons, knowing what the market is going to do in 2, 3, 5 years, even 2, 3 months, is anybody's guess. So coming up with fixed interest rate is something that not only protects us, but it protects our investors. Moving down to the down payment, $4.8 million is our down, 4.4 in closing cost, which covers all of our broker fees. Unfinanced rehab, which was our CapEx plan and business plan, which Jai went over very well for us tonight. And what's covered up there, the working capital, we have $100,000 in working capital And again, the great piece about this is there's a lot of loans out there, preferably bridge loans, even fixed loans, agency loans will allow you to get that unfinanced or the CapEx money as financed. The problem with that is it takes a long time and you have to apply to get it. It comes under a lot of scrutiny, and it's hard to manage the cash flow on a property. So making the decision, the business decision on this team to raise that money up front allows us greater flexibility to make changes to the business plan as things change, as the property changes. Over to the bulk of it here, you see the unit mixes. A lot of the unit mixes, we have a lot of 1-bedroom and studios, really focused on individual tenants. We're not going to service a lot of families here, and we know that. It's going to be a working professional, white collar individual. Rents here for the first year, we're projecting 10%, as you can see highlighted on the bottom right corner. 10% rent growth, which is conservative compared to what CoStar is projecting for this region. Our total returns are 97.4. Average cash flow over the 5-year hold is 5%. Next slide, please. Here's our 5-year cash flow projection. Down on the bottom left, we'll get into a little more of this later. We've talked a little bit about the reversion cap rate. We're purchasing this property for a 4.2% cap rate on its trailing 12. Our reversion, basically what we're saying we're going to sell it for, what the market is going to be in year 5 when we go to sell, is 5.25. It's 105 basis points higher, which is super conservative. The CoStar report that I was showing earlier stated in 5 years, in 2020, 2027, 2028, the reversion cap rates or projected cap rates are going to be 4.7. In a couple slides, I'll have a reversion cap rate sensitivity chart where I'll show you how impactful that is to investor returns. Another highlight here is across the top, the economic vacancy. The property is currently, if you look at the trailing 12 and trailing 3, 18.2% over the trailing 12 months, 14.7 over the trailing 3. A lot of this is due to most of the current tenants not paying market rent. They haven't kept up and they've been on the property for a long time. Now, that's great news that tenants love the area and love the market. They love the property and the amenities that it comes with it. Our goal is to get them closer, if not up to current market rents, and reduce that economic vacancy. One thing that has been hitting the market is, or been a problem in multifamily in some communities around Dallas, Fort Worth, and Houston, and all across the country really, is delinquency. Tenants coming upon hard times or losing their job, not being able to pay rent. I'm happy to announce that we have one property that's in financial hardship in the delinquency area. So year 1 projected economic vacancy is 15%. We're carrying the same for year 1. That's really to protect us and give us some time to get that. It's conservative. It's a conservative approach, which is how we underwrite. Our expectation is that we under-promise and over-deliver. So 15% economic vacancy in year 1. We'll reduce it a little bit to 11% in our underwriting in year 2, and then 9% thereafter. Down across the bottom, you can see the cash flow, 5.8% in year 1, 6% in year 2, and then 7% and beyond in year 3, 4, and 5, which is very healthy and in line with what the market is telling us today. The other thing I want to bring up here is the other income. Year 1 other income is showing a 30% gain from the trailing 3, what the property is currently collecting for other income. Very conservative yet again. Year 2 other income increases 25%. Year 3 is 10%. We are not showing or underwriting 100% gain on our business plan and what we plan on adding to the property and adding to the tenant's lifestyle on our property. So another area that we intend on beating, only to provide greater returns to tenants or to investors early on in the hold period. Next slide, please. Here's the stress testing scenarios. I'm sorry. So first scenario here, this is part of our exit strategy. I'm sorry, not yet. This is the break-even vacancy. So we do some stress test on the property just to see, give us some benchmarks on the worst case scenarios and what would happen for us to be able to cover all of our expenses. So what this is showing is we've tweaked the economic vacancy and increased it to a point where there's zero cash flow on the property, yet still paying our mortgage and all of our expenses. So in order for that to happen, we would have to have 30% or 37% vacancy and only 63% occupancy, which is not very realistic at all. So this is one of the stress tests we do. Next slide, please. The next stress test is scenario 2, where we have no rent or other income growth and the expenses still increase as we have them underwritten. So to go through the expenses real quick, year 2, 7%, year 3, 7%, 4, 5, and 6 is 3%. So the increased expenses in year 2 and 3 is to cover the taxes in Dallas County. Dallas County increases taxes up to 95% in the first 3 years. So we have that covered in our expense growth. And as you can see on the stress test, that the property still generates very healthy cash flow with no rent increases or other income increases over our 5-year hold. Next slide, please. Scenario 3 is whether interest rates keep going up. Obviously, we've highlighted multiple times that we have a beautiful loan, fixed rate agency loan with 1 year of IO for 5 years. If interest rates go up, obviously that has no effect on us. Our rate is fixed and it will not be impacted. Next slide, please. Scenario 4 is a refinance. So this is something that we would communicate based on the market conditions, what interest rates do. So we have 2 different models here. Both of them are based on a refi in year 3. Interest rates are 4%. Obviously, this would be interest rates going down from today's interest rate market. The difference is the loan to value. So right now, the loan that we're getting is 63%. That's what banks are comfortable providing debt on right now. So in 5 years or 3 years time, if we get a loan to value of 65%, we would be able to return $3.8 million to investors, about 65 to 70% of our raise amount and of investor capital, which would be an 8.3% average cash on cash return. The bottom model would be an 80% loan to value, in which we would be returning 100% of investors' capital, invested capital, to investors, meaning that the rest of your return would be infinite. You would have your initial investment back. Everything after that would be gravy. So 4%, 4.6% would be the data point for cash flow in year 1 to 3, and infinite return thereafter. Next slide, please.
Steve, before I move on, I just wanted to mention that we have not underwritten this into the model. This is just an exit strategy and what would happen, but we are not counting them right now on the returns that we are presenting to you at 97%. Is that correct, Steve?
That is correct. Okay, here's our reversion cap sensitivity analysis. So in the middle, the 5.25% reversion cap rate is currently what we have underwritten, which yields a return of 97.4% on your money. Now, the upside, if one of the earlier slides that I presented, 4.7 was the forecasted reversion cap rate per CoStar. If 4.7 is what we end up selling it for, 129% would be the upside. So even greater return. Now, let's say things don't go as planned and the cap rates end up increasing. An increased cap rate reduces the overall return. At a 5.6 reversion cap rate, we're still returning 82% on your money over a 5-year hold. Still a very, very attractive return, only really seen in multifamily investing. So very strong reversion cap rate sensitivity. So again, we believe we're very conservative. We expect the cap rates to be in the super low fives, maybe even the high fours. Next slide, please. I'll now turn it over to Tasia to go through the projected timeline for investors.
Thank you, Steve. So we're gonna review the timeline to close this deal now. So the next, these next couple of slides are very, very important. And there we have 2 slides for timeline and 2 slides for wrap up, and then we are going into Q&A, okay? So stay with me. So where are we on the timeline? For the new investors, the following steps on the acquisition process are behind us. As you can see, we have made an offer which was accepted. We have signed the contract to agree on the terms, and we have had the due diligence and inspections performed, and today we are at the webinar. There are only 3 weeks between now and closing. And as such, you have little time to make your commitment, review and sign the subscription documents, and wire the money. So we can make a successful closing date on November. Now, if you are ready to partner with us, here's what you need to do next. First, let your sponsor know of your intention to invest. Let me know. I will send you a link to the investor portal. You will create a login and review the contracts, also known as subscription documents, which were developed by our security attorneys to protect us all. You will then e-sign the document online, and our investor relations will review and countersign the subscription documents. Once that is done, you will then receive direct wire instructions from the investor relations. But please confirm with your sponsor that the information you received is correct before you wiring your funds. And then wire your funds as soon as possible. This is a Class A deal on a very sought after submarket, and we expect the deals to subscribe quickly. We want to remind you that we will accept investments on a first come, first served basis. And if you plan on investing with an IRA or 401k, which you can also do, and if you don't know how, please reach out to us, move even faster, because there could be hiccups that is that is a little bit slower than just writing a wire, right? Now, if you're still unsure, talk to your GP. They will help you with your concerns and think through this process. Now, I want to give you my final thoughts before the Q&A. About 2 weeks ago, I sat in a room with 1,000 people listening to entrepreneurs, keynote speakers, and experts in the real estate industry. And what I learned is that the real estate market, multifamily especially, is still an asset class the experts are bullish on. More important, the thought that stuck with me was this one on the screen. Jesse challenged us to put ourselves in a situation to attract luck. You are here today, and this is you putting yourself in a situation to attract luck. Deals like this one will not knock on your door. You have to show up and get them. So let's recap. Why do I like this deal? And all of us like this deal. It is in an excellent location close to downtown and trendy neighborhoods, an area that is under advanced stages of gentrification, which you probably saw in the video, the nice buildings and new buildings that are around. And this is perfectly aligned with the demands of the target demographic, which is the young professional, which, by the way, I believe will be less sensitive to recession. Also, this is a Class A boutique style project with a price per door lower than comps. We have a fixed rate finance, which we stressed throughout this presentation, which will protect us from interest rates. But also, if you have been considering investing in single family homes, today you probably cannot get a 513 fixed rate financing as an individual. So moving into the multifamily space might be a good deal for you with less work that you would have on the single family side. And finally, we have a team with experience to make this project success, as I outlined in the beginning. The icing on the cake is that this is a recession-resistant asset, which can also hedge your dollars against inflation. And lastly, you heard a little bit before, or maybe we didn't, but you will be able to leverage the power of bonus depreciation, which can generate tax benefits in real estate. There is a regulation that we can take advantage of accelerated depreciation in the early stages of the process, which generate paper losses that you can use to offset the cash on cash that you will receive. And sometimes later on, you can accumulate them to go against your capital gains. Now, you need to talk to your CPA, make sure that this applies to you. But we now get to the end of our formal presentation, and we would like to go to questions. So if you have questions, type them into the chat, and we will try to address them as a team. And Serbi, I don't have visibility to the questions, so if you don't mind taking over, that would be helpful.
Sure. So I think they can type the questions in the question box. So I'm waiting for folks to type the question. No question, guys. Will you do an awesome job?
Yeah, so if there are no questions, anyone listening and tuning in tonight, if you end up having questions, please get back or send an email or call the sponsor that you have the best relationship with to get your questions answered. You will be getting an email from a sponsor with the recording tonight, as well as a slide deck so you can review it on your own time. Again, this is a fast-paced moving investment, so please get back with them and circle back with them at your earliest convenience.
So there is a question, it says, is there a preferred return rate? So we're not doing any preferred returns because we want investors to go through the upside with us. Typically, if we do a pref return, the investor gains are capped at a certain number, but we are doing a straight equity split. So investors make, there is no cap on how much they make. Any other questions?
Hey, I have one comment that I want to make while there might be still asking. In terms of the frequency of the distributions, we tend of the cash on cash. I think the idea is to start paying typically 6 months after the acquisition and takeover, because we need a few months to transfer from property management as well and stabilize the property. But thereafter, we will pay distributions on a quarterly basis. Also, we intend to communicate the status of the project to you on a monthly or quarterly basis. And any other administrative comments that we might have not covered, Serbi or Steve?
So there is a question about 401k and IRA. So you cannot invest from a 401k or a IRA directly. What you will need to do is convert your IRA account to something called SD IRA, which is a self-directed IRA account. And there are specific companies that allow the SD IRA funds to be invested into real estate. So you have to open this SD IRA account with that specific company like Quest IRA or Neighbors or Madison. Typically, bigger brokerages like Fidelity or Schwab or TD Ameritrade, they do allow SD IRA accounts, but they don't allow investment into real estate. So if you are looking to invest from your IRA account, please reach out to one of the sponsors so we can talk more about this IRA investment. And there are both pros and cons of using the IRA account. So feel free to reach out to us and we can discuss more.
While waiting for the questions here, I just want to make a comment. Most of you may already know that 2022 is the last year of 100% bonus depreciation. So this being closer to the year, this is a fantastic opportunity for the investment where you would be able to take benefit of 100% bonus depreciation.
Hey, Steve or Jai, can one of you speak a little bit to the type of inspection that we have done in this property?
Sure. So we had Mayan as our property manager that we are bringing on to their professional third-party manager with great experience in the area. Part of them coming on and joining us, partnering with us on this deal, they brought a lot. They did the due diligence alongside us and brought their specialized contractors with us as well for due diligence. It was a week and a half process. We brought on plumbers, we brought on roof inspectors, structural inspectors, electrical inspectors, interior, and then we also went through all of the documents. So we did a complete audit of the financials of the current tenants and their contracts or leases. So we've also sent cameras through the plumbing all the way to the street to confirm that there's no issues with that, and it is in fact new. We've inspected all the HVAC units, all of the plumbing fixtures. So we have essentially torn this place apart and inspected it.
Thank you, Steve.
I guess there are no more questions. Daisha, we can let people go. I think it's getting late anyway. So if anyone has any questions, please feel free to reach out to us. And thank you everyone for joining us today.
Thank you, everyone.
Bye.